To talk about the new RBI norms in real estate sector, we are joined by two distinct guests, Mr. Anuj Puri, Chairman and India Head of GLL, along with him Irfan Razak, Promoter and Chairman and Managing Director of Prestige Estates, who joins us live from Bangalore. Irfan, let me kickstart the discussion with you. Reserve Bank of India is clearly trying to squeeze liquidity out of the real estate market as they've raised a red flag for banks who currently are giving money to builders via the 80-20 or the 25-75 scheme. Do you think this move is going to suck liquidity out?
Actually, I don't think it will affect any liquidity at all. Probably Reserve Bank is just taking a little cautious route because of late there have been a lot of offers on this 80-20 and 75-25 route. We as a company, we have never given this sort of a scheme to any of our buyers. But the home loans are still available. Borrowers can still borrow home loans. So I don't think there's anything that's dramatically going to change, except that schemes like this will die a natural death because the Reserve Bank has red flagged these sort of schemes. But at the same time, I don't think that's going to affect in any way any liquidity to home loans because as I always keep saying, housing is a need and the government realizes that and they definitely want people to get homes and they will definitely allow borrowing for home loans which are genuine, not in the speculative mode.
Anuj, hi, morning. Firstly, it was the land bill and now this scheme. Can you throw some more details of what sort of issues of the 2080 scheme and what you believe the RBI had as a main concern with this one?
I quite agree with what Irfan said, that, one, there isn't really as much momentum on this 80-20 other than in Delhi and Bombay. If you were to go into the other cities, there isn't an offering of 80-20 that happens as frequently as it happens in Bombay and Delhi. The second is, I'm not sure what Reserve Bank is trying to do, whether it is trying to, take out liquidity from the real estate sector or whether it's trying to snub the speculators, because clearly this 80-20 was pretty much reliant on the home loan to the end user. Because, ultimately the developer who was taking the 80-20 scheme, once the development was complete, was converting that into a home loan for the buyer. So not sure what the objective of RBI is, but definitely in cities like Delhi and Bombay, where the scheme had caught up momentum over the last few quarters, they're going to find it difficult to, the momentum that had caught up, there will be some drop in the sentiment and consequently a drop in the sales on the schemes that were offering 80-20 or 25-75 to the buyers.
Right. Irfan, is Prestige currently running any 80-20 schemes? And if yes, would you be forced to pull them back?
No, as of today, we have not even thought of running such a scheme because we felt there was no need to. Basically, I'll just tell you this 80-20, what it means. It means that, first of all, the developers in whichever segment they are in have priced their products higher because they're picking up the interest cost of the product from the buyers. That gives a sense of a little bit of a comfort to the buyers that they don't have to pay interest till the product is ready. So obviously the price is padded up with the cost of interest. And without the 80-20 scheme, I think pricing will be much better, more reasonable, and at the end of the day, the buyer gets a far better deal without the 80-20 scheme.
Right. Anuj, is there anything wrong with the 80-20 scheme in principle? Do you think that could be a systemic risk if this scheme is continued?
I think where the thought of the Reserve Bank of India may have gone is that is this propagating speculation? Because what really you need to do is pay only 20% today and the balance 80% you have to pay at the time of delivery. And usually what happens is today if you were to invest and it's at a lower price, and once the development is complete, it's at a higher price, and hence you are able to get the cost escalation or the price escalation. And that a speculator may do, just put in 20% today and then forget it, and 3 years later, once the development is complete, you bring it and sell it into the market and make a profit on that. So I think that's where they may have said is that this is not really being used by the end users as much as speculators who are just putting 20% today with the hope that by the time the development is complete, it's going to be priced higher, and hence you are able to make a profit margin out of that. And that's probably they want to weed out from the market by, stopping this scheme.
Irfan, what is your take on pricing? Do you think prices are likely to get impacted or come down in light of what the RBI has chosen to do?
No, see, I can't discuss these prices with I can't talk about it the same paintbrush, because there are markets where the prices are already very reasonable and low, because I believe that the price input is a function of land cost, construction cost, developer overheads and his margin. And but wherever the prices are inflated in terms of there's a huge padding in terms of higher profits, or there's what we call a speculative figure included in the prices, those will correct themselves, and that will happen only to the very, very high-priced properties. But wherever you're doing work for the mid-income group and you're following this principle of cost plus, there's no way that the price can come down because the input costs on a daily basis are rising. So it's either you don't build and give to your customers, or you build and whatever the cost effect is there, that's what you're charging them. So there's no way that price can come down ever in the mid-income group. Wherever there's that speculative margin included, that will probably correct itself slightly, and that's in a different segment, different markets, and we can't really generalize this across all markets or across all segments of residential property.
Anuj, final question, 30 seconds to answer this one. 80-20 schemes are popular in Mumbai and the NCR region. Those schemes will be pulled off. Do you expect a 10 to 15% current, drop in fresh construction?
There would have been, say, 2 schemes out of 10 schemes which would do this 80-20. So, clearly it wasn't that the full market was on 80-20. The second is that the interest cost by giving this subvention scheme, that's what it is called, it was included in the price. So clearly that interest cost will need to be taken out. And with that, you will see the drop in the price. Because ultimately what was happening, the developer was pricing the subvention cost into the pricing of into the cost itself. So that, because the scheme has gone away, he will need to take that, cost away. So the buyer will certainly get it cheaper than what he or she was getting in the 80-20.
Okay, Irfan as well as Anuj, good to have you guys on board with us and get us some more perspective on RBI's 80-20 scheme.